Hey there, folks. This is Deeksha Janiani representing Team Trendline. And in this week's video, we will discuss India's potential as an emerging manufacturing hub and the challenges associated with the same. Our special focus will be on the chemicals and the electronics sector. Within the sector, we will analyze top companies which are planning which have massive expansion plans for their existing product lines and new products. So let's get right in. Folks, there is an increasing clamor around India becoming a global manufacturing hub by the year 2030. The central government shares a similar vision and reiterated the same in the recent Asian summit. In fact, to give a massive push to domestic manufacturing, the center had announced a production linked incentive scheme back in 2020 and had also eased the foreign direct investment norms in sectors like defense and telecom. The global trade environment had also become favorable for the Indian manufacturing sector post the pandemic. The COVID-19 pandemic had restricted the movement of men and material across nations. This resulted in supply chain disruptions, due to which countries struggled to procure essential material from their usual regions. Accordingly, they decided to diversify their supplier base. India rose to the occasion and its manufacturing exports jumped over 40% year on year to 418 billion US dollars in FY22, according to a Bain and Company report. In fact, that report sees India's manufacturing exports touch $1 trillion by FY28. This effectively translates to a CAGR of 16%, which will be achieved in the next 6 years. Now, to achieve such this milestone, India not only needs to make higher investments in capacity, but also needs to address some key challenges. See, India has natural competitive advantages in terms of a skilled and a cheap workforce, but it suffers on account of poor infrastructure, erratic power supply, corruption, and dated legal structure. And in fact, nearly 2,700 foreign companies exited India between 2014 and 2021 due to these same reasons. And in order for India to become a global manufacturing hub, the need of the hour is high speed logistics and simpler labor laws. Let me give you an example of an archaic labor law here. So, according to the Industrial Employment Standing Orders Act, the employers having 100 or more workers need to seek permission even for a thing as simple as reassigning a worker from one task to the other. So there is a long way for our there's a long way for our country, but we have made significant improvements in terms of ease of doing business. So India's ease of doing business rank improved to 63 in 2021 from 142 in 2014, according to a World Bank report. So coming back to the target of $1 trillion worth of manufacturing exports, the Bain and Company report sees six sectors driving the double-digit growth. These are chemicals, electronics, textiles, industrial machinery, automotives, and pharmaceuticals. As I already stated, our focus in this video will be on chemicals and electronics. So, folks, chemical sector saw a massive expansion cycle between FY15 and FY20. In fact, the capex grew at a CAGR of 17%. The companies got the benefit of this higher scale when in the pandemic era, when foreign players were actually looking for new supply partners. Going forward, the chemical sector's exports are set to grow at a CAGR of over 20% in the next 6 years. And within this sector, specialty chemicals and agrochemical segments will grow much faster than the others. Accordingly, top leading chemical players are embarking on a new phase of expansion to leverage these opportunities. So, companies like SRF, UPL, Tata Chemicals, RT Industries, and Gujarat Fluorochemicals are planning a capex of over 10,000 crore in just FY23. In fact, if you look at the overall capex plan by the top 7 companies in chemical sector, it's way more than the capex plan by the top 4 consumer durable or electronic companies. So the moolah is clearly going in the chemical space. Now, specialty chemical player SRF leads the show in terms of its capex plan for the next 2 years. Even for the longer term, companies planning to spend over 15,000 crores across agrochemicals, pharmaceutical intermediaries, and fluoropolymers. Now, the foray into fluoropolymers is particularly interesting here. So, see, fluoropolymers are temperature and pressure resistant material which find their application in green hydrogen technology, solar panels, data processors, sensors, and semiconductors. This makes them critical for use in transition to clean energy, for adoption of 5G technology, and manufacturing of electric vehicles. Citing similar reasons, Gujarat Fluorochemicals is also preparing for a foray into this segment. Additionally, the company has set aside 2,500 crore to be spent on a battery chemicals complex, which will prepare it for the upcoming transition to electric vehicles. A part of this capex was already spent in FY22. Now, Aarti Industries is other player which is planning a major capex of over 3,000 crores in the next 2 years. This capex will be spent in introducing new downstream products in the current benzene segment and also in the new chlorotoluene segment. Now, the materials produced in the chlorotoluene chemistry are used as intermediates in the agrochemical and the pharmaceutical space. Now, one more thing is here that the company is looking to triple its revenues to 13,500 crore by FY27, backed by these capex plans. Another player, another commodity chemical maker here is Tata Chemicals, which is already in midst of an expansion plan involving extension of its soda ash and sodium bicarbonate capacities. Now it is embarking on phase 2 expansions, which will entail an outlay of 2,000 crores to be spent between FY24 and FY27. Yes, that's right. The company is seeing higher demand coming in from solar panels and lithium battery segments. See, ultimately, the larger theme of clean energy transition is driving the capex plans for this commodity chemical maker as well. Now, coming to the growth expectations, consensus estimates of analysts, according to Trendline's forecasters, see most chemical companies clocking double-digit revenue growth in the next 2 years. But however, in these companies, hydrofluorocarbon makers like Gujarat Fluorochemicals and SRF stand out. See, the prices of hydrofluorocarbons will continue to operate at higher levels owing to robust demand and tighter supplies. Also, so given this stable pricing and higher demand from the rebound of auto sector and industrial activity will ultimately drive the top line growth of these companies. However, if we come to the bottom line growth estimates, agrochemical players like PI Industries and UPL clearly stand out because these companies have also upgraded their revenue guidance for FY23, citing higher export demand across geographies. So, this factor, along with the possibility of margin expansion, will ultimately trickle down to the bottom line growth for these companies as well. Now, UPL particularly looks to be quite particularly looks to have quite an appealing valuation here because the analysts are estimating this company to clock earnings growth of more than 25% in the next 2 years. Uh, Given the similar growth expectation, PI Industries looks to be much more expensive than UPL. Now, coming to the electronic sector. So, the exports from the electronic and the electrical sector will grow at a CAGR of over 35%, fastest among all other sectors, to reach $133 billion dollars by FY28. In fact, the mobile phone segment in within this sector is expected to go the fastest. So recently, Apple announced that it will manufacture iPhone 14 in India, and this actually reflects the sheer potential that this segment has. Now, Dixon Technologies is the second largest contract manufacturer for mobile phones in India. Though it is also present in other segments like consumer electronics and lighting products, this segment particularly grew ahead of others. So, if you see the segment contribution in within the revenue pie of Dixon Technologies grew by over 15 percentage points in FY22. And the growth story of this segment has just begun. As Sunil Vachani, who's the chairman of Dixon Technologies, sees a long-term opportunity in exports of $100 billion and of 4 lakh crore in the domestic market for just this segment. Now, the company, in order to leverage these opportunities, the company is planning a capex of 320 crore in FY23. And it is also a leading beneficiary under the PLI scheme. So, of course, some part of this capex will also go towards that. Now, Havells is another beneficiary under the PLI scheme. The company plans to spend 750 to 800 crores in FY23 across its products like washing machines, air conditioner, and cables. KEI Industries, another cable maker, which plans to spend 750 to 800 crores in the next 3 years. Now, the company KEI Industries is seeing higher demand coming in from the renewable energy sector, from metals and mining, and oil refineries, owing to the overall thrust of the government on the infrastructure sector. Yes, that's right. Now, see the company. If you see, contract manufacturers like Amber Enterprises and Dixon Technologies will grow faster than the other consumer durable players. And in fact, Dixon Technologies' revenue growth will be driven mainly by its mobile segment and its home appliances segment, which basically consists of the washing machine product. Yes, that's right. And now, see, the point is Dixon Technologies is commanding higher valuations because market is baking in these high growth expectations from the company. So if, and see, the company, we do understand that the company is a key beneficiary under the PLI scheme, but in case there is a blip in the earnings growth of the company, there is a possibility of a major price correction. In contrast, KEI industry looks to be particularly appealing because of its reasonable valuations and high growth expectations at the same time. So, folks, this was my time, and I hope you must have gained some insights on the capex plans and the growth expectations from chemical players and electronic players. So, have a nice day and see you.